All right, well, we're rounding out the month of March 2017. A lot has happened. The Trump bump, which Bob will talk about, has gone up and down like an EKG through the month. We've had a nice run. We also had a Fed rate hike, and we had repeal and replace nosedive in the last few days. So real quickly, I'm interested in talking very briefly about the rate hike in March 15th, which was forwardly guided and pretty well predicted. The Fed raised rates by 25 bips, and usually when that happens, bond prices go down. In this case, the bond market rallied on a rate hike. I've talked about this, and Bob and I talked about this at the office. We've written about it. It's interesting when you look at the long duration bonds, anything over a year in the Treasury. Central banks of the world, not just the Fed, but the ECB, the Bank of Japan, the Bank of England, own 2/3 of the Treasury market over a year in duration. So what it means to me is the bond market or the Treasury market is not really a natural market.
Not a real market there.
It's not a real market, and it begs the question of just how much training wheels can an economy, or more importantly, a stock market, take when you've got this much support from the Fed on interest rates, and of course the money printing, which will come. And even the Fed said on the 15th, if we see a correction or a downturn, we'll just print more money. We're bears, obviously, cynics, obviously, but if we're going to do more of these stimulus effects for years to come, can the Fed go from $4.5 trillion to $6 trillion to $8 trillion to $10 trillion? When will this charade end? But it's a fascinating month, and you can talk to us about fascinating.
The charade ending, yeah. Well, I think we've got more money to print. Until then, let's take a look at what's also on everybody's minds is the failure of the Obamacare repeal bill, or what's called Ryan Care. For Paul Ryan, Speaker of the House. It failed to even come up for a vote in the Republican House. So this obviously is not a good sign for future tax reform, infrastructure cuts, and so forth, but it does mean they'll be focusing on that a little more. The reality is the market took it poorly at first, and then it's reacted better afterwards. And that has snapped one of the longer losing streaks that Dow's actually had for a while, but these are all very modest losses. But bottom line is we don't know exactly where this thing is going to go. It could be like Brexit, where you get a little bit of a boost, but our guess is that we're in for a rockier ride than what we've had in the past. Certainly more volatility, but it was a very surprising outcome. Not that the bill was not going to eventually maybe get stalled in the Senate, but the fact that it didn't get out of the House is a big deal. And I might add that other presidents, certainly who have been successful, like Ronald Reagan, have had problems at first, early in their term, but that's from a political standpoint, and they worked through it. But in this case, the market had given Donald Trump a lot of credibility in getting things through quickly because of his business sense, and of course we had the greatest rally between election and inauguration since Herbert Hoover. So that's kind of the issue we're dealing with now. Is it's not unusual to have problems. It is unusual for the market to assume there won't be any, and that's kind of what's happened. So price for perfection, but we're not necessarily seeing that going forward in Congress.